Michael Saylor has recently executed the most significant transaction of his career, and now the financial world appears poised to penalize him for it. We are referring to an astronomical gain of $54 billion, not a mere million or even a billion, but a staggering $54 billion in Bitcoin now held within corporate strongholds. Saylor's enterprise, MicroStrategy, now commands an astonishing 649,870 Bitcoin, establishing it as the preeminent corporate custodian of cryptocurrency globally. Consider that for a moment, a software firm, largely unknown to the majority of Americans just 3 years prior, now possesses more Bitcoin than numerous sovereign nations. However, the narrative takes a truly extraordinary turn from here. Saylor did not simply acquire Bitcoin and cross his fingers, akin to some Silicon Valley entrepreneur squandering investor funds. He transformed a staid enterprise software company into what financial experts are now dubbing a market advantage, a cheat code for the entire financial landscape. MicroStrategy effectively became the bypass that institutional investors desperately sought, providing a pathway to gain exposure to cryptocurrency through the conventional stock market without direct engagement with digital assets themselves. The outcome? His company's stock has utterly eclipsed its rivals. While the S&P 500 delivered modest gains and even Nvidia enjoyed its moment in the artificial intelligence spotlight, MicroStrategy's stock price experienced a meteoric ascent. Institutional investors who were unable or unwilling to purchase Bitcoin directly could simply acquire MSTR shares and participate in the cryptocurrency boom, backed by the credibility of a company listed on the Nasdaq. Pension funds, hedge funds, and traditional asset managers all flocked to the opportunity. Saylor had seemingly discovered a fundamental flaw in the financial architecture. One would anticipate that Wall Street would laud such an innovative achievement, wouldn't they? A visionary who foresaw the trajectory of digital assets ahead of the curve strategically positioned his company with exceptional skill and generated immense wealth for his shareholders. In America, such foresight and execution are ostensibly rewarded. That is the very essence of the American dream: to make a bold wager, execute it flawlessly, and achieve monumental success. But here lies the critical revelation that should command the attention of every American investor. The Nasdaq 100 Index Committee does not perceive Michael Saylor as a pioneer. They view him as a disruption. According to their established regulations, MicroStrategy has committed what they deem a grave transgression in contemporary finance. By dedicating all its resources to Bitcoin, holding over 50% of the company's assets in a solitary investment, Saylor has violated their fundamental principles of diversification. Reflect for a moment on the sheer irony of this situation. The individual orchestrates the transaction of the century, transforms his shareholders into Bitcoin millionaires, and outperforms virtually every major corporation in America. His reward? The index committees are preparing to classify his company as problematic and eject it from their ranks. To them, this is not a success story warranting celebration. It is a dangerous concentration of risk that imperils their meticulously constructed framework. Retribution is imminent, and it will be delivered without subtlety. Financial institutions do not merely extend polite invitations to depart when their rules are broken, they effectively erase you. And when a company is removed from a prominent index like the Nasdaq 100, the ramifications propagate throughout the entire financial ecosystem in ways that often elude the comprehension of individual investors. The events that are about to unfold concerning Michael Saylor transcend the fate of a single company or a controversial investment in cryptocurrency. This situation exposes the true workings of modern markets when an individual achieves extraordinary success through unconventional means. By employing a strategy that the established order never sanctioned, when you effectively control the market for the very future of money, you are no longer merely competing against other investors. You are contending with the entire traditional banking apparatus, which is determined to dictate future financial developments. And they have just activated a decisive measure. There is a date circled in red on the calendars of every major financial institution: January 15th, 2026. This is when the Nasdaq 100 Rebalancing Committee convenes to render its annual judgments on which companies will retain their positions within the index and which will be expelled. For the vast majority of corporations, this constitutes routine administrative work conducted behind the scenes while the nation pursues its daily affairs. However, for MicroStrategy, this is far more than a standard committee meeting. It represents a pivotal moment where a seemingly mundane regulatory adjustment could precipitate a profound financial crisis, potentially erasing billions of dollars in value instantaneously. Here is a crucial aspect of modern market operations that most individual investors fail to grasp. When a stock is removed from a major index, it signifies more than a loss of esteemed membership. It initiates an automatic, non-negotiable, forced selling sequence that propagates through the entire financial system with robotic precision. Let me elucidate this mechanism, as it is here that the narrative becomes truly unsettling. Trillions of dollars managed by passive investment funds and exchange-traded funds are inherently designed to mirror the Nasdaq 100 index. The most prominent example, which you have likely encountered, is the QQQ, an entity overseeing assets exceeding $200 billion. These funds do not employ portfolio managers who make discretionary decisions about stock acquisitions or divestitures based on underlying fundamentals or future potential. They are, in essence, automated systems programmed with a single directive: to hold precisely what the index comprises, nothing more, nothing less. Therefore, what transpires the moment MicroStrategy is officially delisted from the Nasdaq 100? Every single one of these passive funds receives an automated command to liquidate its holdings of the stock without delay. We are not discussing a gradual, strategic divestment wherein astute fund managers meticulously time their exits to mitigate losses. We are referring to institutional computing systems executing market sell orders with absolute disregard for price, liquidity, or prevailing market conditions. Consider your own actions when placing a market sell order through your brokerage application. You are essentially instructing the system to sell my shares immediately at whatever price is offered. When you are disposing of a few hundred or even a few thousand shares, this is inconsequential. The market readily absorbs such transactions. However, when we are addressing passive funds that collectively must divest hundreds of millions of shares within a compressed time frame, the situation becomes catastrophic. Analysts at JP Morgan have been issuing warnings regarding precisely this scenario in their internal research reports for institutional clients. They have termed it a liquidity trap, and this appellation should instill profound apprehension in anyone holding MicroStrategy stock or Bitcoin itself. Currently, the principal purchasers of MSTR shares are these colossal index funds mandated to hold the stock due to its inclusion in the Nasdaq 100. However, the instant delisting occurs, these obligatory buyers vanish from the market instantaneously. Envision attempting to sell your residence only to discover that every real estate investor in your city is suddenly legally prohibited from acquiring properties. This is not a scenario conducive to negotiating a slightly reduced price. It is a situation where finding a buyer at any reasonable valuation might prove impossible. The market does not merely decline, it effectively ceases to exist. Now it is here that Michael Saylor's financial edifice becomes exceptionally vulnerable. Recall that he did not amass this $54 billion Bitcoin position solely through existing cash reserves within the company's accounts. Saylor employed one of the most audacious financial engineering strategies in modern corporate history. He issued convertible notes, which are essentially loans from institutional investors who agreed to provide capital with the stipulation that they could convert these loans into MicroStrategy stock at predetermined prices. According to regulatory filings, MicroStrategy has outstanding convertible notes valued in the billions of dollars, each with varying maturity dates and conversion prices. This strategy proved exceptionally effective as long as the stock price continued its upward trajectory, as lenders were content to either receive interest payments or convert their loans into highly valuable shares. However, this entire construct hinges upon a critical assumption: the perpetual availability of liquidity in MicroStrategy stock. The moment this assumption is invalidated, the entire structure begins to falter. If the forced selling pressure resulting from index delisting causes the stock price to plummet below specific thresholds, certain convertible note agreements contain provisions that could empower lenders to demand immediate repayment, and here resides the nightmarish scenario that keeps financial analysts awake at night. If multiple lenders concurrently demand their funds back, from where precisely will MicroStrategy procure the capital to satisfy these obligations? The company's primary asset is Bitcoin, an asset notoriously prone to volatility and increasingly illiquid in substantial transaction volumes. Saylor cannot simply contact an exchange and liquidate $50 billion worth of Bitcoin on a Tuesday afternoon. Such a colossal selling effort would destabilize the entire cryptocurrency market, further depress the stock price, potentially trigger additional debt repayment obligations, and necessitate the divestment of even more Bitcoin. This is precisely what financial professionals refer to as a death spiral. Each mandated action exacerbates the situation, triggering further mandated actions, thereby accelerating the decline. Furthermore, unlike a conventional bank run, where regulatory bodies can intervene to suspend trading or provide emergency funding, there is no safeguard against this particular scenario. The index regulations are absolute, and the passive funds will execute their selling programs irrespective of the repercussions. What renders January 15th particularly punitive is its timing. We are not contemplating a decision that might arise at some indeterminate future point if conditions worsen. This is a definitive deadline rapidly approaching. Regardless of Michael Saylor's preparedness, the committee will convene. They will scrutinize MicroStrategy's asset concentration, and if the Bitcoin holdings continue to constitute over 50% of the company's assets, delisting will be automatic. Saylor is acutely aware of this impending event, as are all major financial institutions. Yet there is virtually nothing he can do to avert it without abandoning the very strategy that propelled him to success. Theoretically, he could divest a portion of his Bitcoin holdings to reduce the concentration, but this would negate the fundamental purpose of his investment and likely depress the price irrespective of the selling volume. He could endeavor to acquire other substantial assets to diversify the balance sheet. However, what company could he possibly acquire that would be sufficiently large to counterbalance $54 billion in Bitcoin assets? The trap has already been meticulously set. The mechanism is irrevocably in motion, and on January 15th, someone will initiate the sequence of events that could culminate in the most significant forced liquidation in the history of cryptocurrency. The only remaining question is whether Michael Saylor possesses an additional stratagem, or if the system is poised to make an example of the individual who dared to achieve excessive success. Now let us consider the potential ramifications if this death spiral indeed commences. Once those dominoes begin to fall, the consequences will extend far beyond MicroStrategy's stock price or even Michael Saylor's personal fortune. This could precipitate a wealth destruction event impacting every American who holds Bitcoin within their investment portfolio. Visualize the unfolding sequence of events in real time. January 15th arrives. The Nasdaq committee renders its decision, and MicroStrategy is officially removed from the index. Within hours, the passive fund computers initiate their program directives. Hundreds of millions of MSTR shares are unleashed onto the market with a mechanical indifference to price. The stock, which had commanded premium valuations due to its Bitcoin leverage, rapidly transforms into undesirable inventory that institutional investors are desperate to divest. As the share price plummets, convertible note holders begin to experience anxiety. They observe their investments diminishing in value by the minute and begin scrutinizing the fine print of their loan agreements. Some of these notes contain protective covenants that are triggered when the stock price declines below specific thresholds. Others include stipulations permitting early redemption if the company's financial standing deteriorates. The phone calls commence at MicroStrategy's finance department. Lenders are demanding their funds back immediately. Michael Saylor finds himself confronting an untenable choice. He could attempt to refinance the debt, but who would extend credit to a company whose stock is in freefall and whose sole significant asset is a volatile cryptocurrency? He could endeavor to raise capital by issuing new equity, but the forced selling has already decimated the market for his shares. Every conventional financing avenue necessitates either willing lenders or willing equity investors. At this juncture, both categories have effectively vanished. This leaves only one recourse, the option that Bitcoin holders worldwide fervently hope he will not be forced to consider. Michael Saylor would be compelled to commence selling the Bitcoin itself. Now you might be thinking, so what? He sells some Bitcoin, settles his debts, and moves on with his life. However, this is precisely where you must comprehend the sheer magnitude of what we are discussing. MicroStrategy possesses 649,870 Bitcoin. At recent valuations, this represents over $54 billion in cryptocurrency. But here lies a critical aspect of Bitcoin markets that eludes most casual investors. Liquidity at such a scale simply does not exist. When you or I purchase or sell Bitcoin on an exchange like Coinbase, we are engaging with amounts that the market can easily absorb. A few thousand, perhaps a few 100,000, if your trading volume is substantial. The order book contains a sufficient number of buyers and sellers at various price points such that our transactions barely register a ripple. However, when you are attempting to liquidate billions of dollars worth of Bitcoin, you're not merely withdrawing liquidity from the market, you are annihilating it. Consider the ramifications when news begins to circulate through cryptocurrency trading channels that MicroStrategy is under duress to liquidate. Every astute trader globally would immediately initiate short positions on Bitcoin, anticipating an imminent price collapse. Market makers would withdraw their buy orders, reluctant to acquire rapidly depreciating assets. Retail investors contemplating purchases would postpone their decisions, awaiting lower price points. The mere announcement of Saylor's potential need to sell creates a self-fulfilling prophecy that amplifies the destructive impact of selling. And here lies the truly devastating element. Saylor does not need to liquidate all 650,000 Bitcoin to trigger a market collapse. According to cryptocurrency market analysis, divesting even 10 or 20% of that position within a condensed time frame would overwhelm global Bitcoin liquidity. The price would not merely decline gradually, it would experience what traders term a flash crash, where automated selling triggers stop-loss orders, which in turn trigger margin calls, forcing further selling and creating a cascade that can evaporate 50% of Bitcoin's value in a matter of hours. Now multiply that impact across every American who holds cryptocurrency. Perhaps you acquired Bitcoin through a retirement account with the hope of funding your later years. Perhaps you allocated a portion of your investment portfolio to crypto, having been advised by financial advisors that it represented the future of digital assets. Perhaps you are simply an ordinary individual who invested a few $1,000s in Bitcoin, believing in the underlying technology and wishing to participate in what appeared to be a transformative financial system. None of these motivations would be relevant once MicroStrategy begins selling. Your Bitcoin holdings would be decimated alongside those of institutional investors, hedge funds, and Michael Saylor himself. The market collapse would show no discrimination between early adopters and recent entrants, between staunch adherents and casual speculators. Everyone holding Bitcoin would witness their portfolio values evaporate as the largest corporate holder in history injects supply into a market incapable of absorbing it. However, let us zoom out for a moment and pose the question that should be occupying the minds of every American investor. How did we arrive at a situation where the forced delisting of a single company from an index could potentially obliterate billions of dollars in wealth across an entire asset class? These are not typical market dynamics where buyers and sellers converge at prices reflecting supply and demand. This is a system where bureaucratic mandates established by index committees can initiate automatic, forced liquidations that cascade through global markets with devastating efficacy. And herein lies the darkest turn of this narrative. Some financial analysts are beginning to voice theories that border on the conspiratorial, yet the interconnectedness of the elements makes them too compelling to dismiss. They refer to it as the bank heist theory, and its premise is as follows. Traditional banking institutions have observed the cryptocurrency revolution with mounting concern for years. Bitcoin represents a fundamental threat to their entrenched control over the financial system. Central banks cannot arbitrarily generate it. Commercial banks cannot create it through fractional reserve banking mechanisms. And payment processors cannot levy fees on every transaction. If cryptocurrency were to achieve widespread adoption as a store of value and a medium of exchange, it would undermine the very business model that banks have utilized for centuries to extract wealth from the economy. However, banks could not simply ban Bitcoin or legislate it out of existence without appearing as the avaricious gatekeepers that crypto proponents invariably accuse them of being. They required a more sophisticated solution, a means of asserting control over the cryptocurrency market without resorting to overt opposition. And Michael Saylor's aggressive accumulation strategy presented them with the ideal opportunity. By enabling Saylor to dominate the market, by allowing him to establish an enormous concentrated position through leverage and convertible debt, the traditional financial system effectively established what military strategists would term a kill zone. They permitted him to march directly into a meticulously laid trap, accumulating ever-increasing amounts of Bitcoin at escalating prices, financed by debt structures that appeared brilliant during the bull market, but would prove catastrophic the moment liquidity evaporated. Now, through a straightforward alteration of index eligibility criteria, they can instigate a forced liquidation that will drive the Bitcoin price from recent peaks back down to the $40,000 or $50,000 range. And who will be poised with billions of dollars in readily available capital to acquire Bitcoin at these distressed prices? The very same major banks and financial institutions that have been discreetly developing their cryptocurrency infrastructure while publicly expressing skepticism toward digital assets. Consider the magnitude of wealth transfer this would represent. Saylor and the early Bitcoin adopters acquired their holdings at lower price points and endured market volatility, believing they were outmaneuvering traditional finance. However, should this forced liquidation scenario materialize, those same traditional financial entities will acquire precisely the same Bitcoin at substantial discounts, accumulating in a matter of weeks what took Saylor years to amass. They will not simply win, they will win by leveraging Saylor's own strategy against him, acquiring the assets he invested billions in, while he is compelled to divest at the most disadvantageous moment. The delisting from the Nasdaq 100 is not a punitive measure for violating diversification principles. It is the trigger mechanism for one of the most extensive coordinated wealth transfers in the history of cryptocurrency. And the ingenious aspect from the perspective of the traditional banking system is that it all unfolds autonomously. No overt conspiracy is required, no clandestine agreements are necessary. It is merely a bureaucratic committee applying its regulations precisely as written, initiating market mechanisms that operate with flawless efficiency, redistributing billions of dollars in Bitcoin from crypto adherents to traditional financial institutions. Michael Saylor staked his entire fortune on the conviction that Bitcoin would become the future of currency. He gambled his reputation, his company, and his shareholders' capital on the belief that decentralized digital currency would supplant the compromised legacy financial system. And now, that same legacy financial system is preparing to weaponize his very success against him, transforming his greatest triumph into the instrument of his potential downfall. For every citizen of the United States observing these events, the core query is straightforward. Do you foresee the ramifications when the entity holding the most Bitcoin in corporate annals is compelled to offload the greatest volume? Because whether one is poised or not, the 15th of January is fast approaching. The progression of time has already begun its relentless march. And upon reaching that specified date, we will all discover if Michael Saylor's wager on Bitcoin proves to be the most advantageous transaction of this era, or a carefully orchestrated scheme for the most significant market manipulation our generation has witnessed.